Howdy, Jacob here. Today we're looking at AGCO Corporation in the machinery industry. 8.6 billion market cap on 9.4 billion enterprise value. PE currently looks very cheap, but we are seeing operating margin quite a bit higher and gross margin quite a bit higher than what it's been historically. So maybe we're just looking at an inflated figure currently. Return on invested capital recently is very substantial, but historically is averaged in the upper single digits. Operating margin has again historically been upper middle single digits, but is currently double digits, and gross margin averaging low 20s, but is currently mid 20s. Balance sheet shows 595 million cash on hand, 15 million short-term debt, and 1.3 billion long-term debt. That 1.4 roughly billion long-term debt is maybe 2.5 years of their 5-year average free cash flow, so not terribly concerning. Their capital expenditures have grown from 10 years ago about 60% or so, but cash from operations have over doubled. So they're going to hit a great production free cash flow. Use of cash is a little bit on the acquisition side, definitely more on the 5 to 10 years ago, but has recently been a bit smaller. More recently, you're looking at a dividend that pays out a pretty substantial amount. You're looking at a 1% yield dividend, but it's paying out maybe, what is that, 70% of their 5-year average free cash flow. It's a hefty amount. A little bit of share repurchases, a little bit of debt pay down. The share-based compensation is nearly offsetting their share repurchases, though. So, I mean, we're ready to make some assumptions here. I think on the revenue growth side, it has grown from 9.7 billion to 14.4 billion, maybe a mid-single digit CAGR. I think I'm probably pretty comfortable with that. Recently, it has grown quite a bit, though, and it wasn't even through acquisitions. So it looks like they manufacture and distribute agricultural equipment and related replacements parts worldwide. Okay, I'm probably going to stick with maybe a 4% range. And then they do have market average abilities, I think. So that's why I'm comfortable with a 16 P in price free cash flow. I'll probably go closer to their average of margins here. And then for share-based share change, I'll probably say that they just really offset that stock-based compensation. A lot of their money is going to be going towards this dividend, which they've been increasing it quite a bit. I think I probably won't increase it. I'll probably increase it just to increase it, just to say that or just so they can say that they've increased it. But to me, again, this is one of those things you got to balance out with what you want the company to do with what they've done historically. And they currently have a 60 to 70% payout ratio. And with the ability or with their recent activity to have a high return on invested capital, I think it might possibly make sense to find some things that you could reinvest in to get that great rate of return. And, if shares get cheap enough, leave a bit of money for share repurchases. I usually don't like it. I don't get concerned when the dividend payout's greater than 50%. It just matters the opportunity here, right? So if they don't have any other opportunities, then paying a dividend can be fine. But, a lot of the times buying back shares of a good, if you're really confident in you being a good company, if you buy back shares even at a fair price, you're really just going to average out, if you dollar cost average it, to the business return. And so here, I think I'm comfortable with everything I see here, and it looks a little bit expensive, not terribly expensive though. So we're just saying it needs to fall 29% to get the return I'm looking for here. Probably not too much longer until I do some research on it, some further research on it, but preliminary numbers do tell me that it does look a tad expensive here. But I hope you enjoy the video. Have a great rest of your day.